So first of all, I just want to thank everybody for coming. This is a great group. We really appreciate all of your attendance. I think it's going to be a wonderful talk, so I hope it's worthwhile for all of you. Before we kick this off and introduce our guest speaker, Christian, I just wanted to have each of our co-sponsors for the event come up and say a little bit about their firm. First, I'd like to introduce our hosts. So Louis, are you going to talk a little bit? Stubbs Alderton is the oldest and probably premier tech law firm in LA, and they've been here for a very, very long time. They've been a great partner of ours and an incredible firm. Louis, do you want to talk a little bit?
Great, thank you, David. Good afternoon, everyone. It's our pleasure to welcome you to the Meet the VC event today. We're also very grateful to have Christian here from Comcast Ventures. A little about Stubbs Alderton. We're a corporate transactional and business litigation law firm focused on representation of emerging growth and middle market companies as well as startups. You can think of us as representing your company literally from formation all the way through exit and beyond. I think one of the things that differentiates Stubbs is essentially our entrepreneurial approach to the practice of law. So not only do we provide legal advice, and we're experts at that, and we have lots of context for it, but we also harness the experience that we've gotten from representing companies over the last roughly, I think, 13 or 14 years, and we provide that advice to our clients to enable them and facilitate their decision making, and we're not afraid of doing that. So it's one of the key advantages, I think, of us representing your startup. My name is Louis Warden. We've got several representatives here from Stubbs Alderton, so feel free to reach out to them. Kevin DeBray's back there. Heidi Upling is here. Caroline Chakasky is also here. I think that's about it. So thank you and welcome, and enjoy the program.
Awesome. Thank you very much. The second person I'd like to introduce is Matt Safford. So Matt runs the LA team for technology in LA. He just had a big promotion, which is a huge, and just got married. Matt, do you want to jump up here and talk about, oh, look at those socks.
Hey guys, thanks for having us. So TriNet, we are a HR in a box solution. I would say if you're looking for empowering your employees, creating competitive advantage, as well as creating a better workplace, TriNet can do that for you. Our shining star is truly our benefits. So Fortune 100 level grade benefits for your employees, a small business. And thank you to our partners. Appreciate it. Good to see you guys.
Awesome. Thank you, Matt. Naveed, where'd you go? So Naveed is with SVB. He runs their early stage group. I think most of you probably know SVB, but Naveed can say a little bit.
Yes, thank you, David, and I'm not wearing any socks. So, so yeah, my name is Naveed. I lead the early stage banking team here in Los Angeles for Silicon Valley Bank. For those of you who aren't familiar with Silicon Valley Bank, based up in the Bay Area, we also have our offices down here focused on working with startups, investors, and VCs all over the United States. And I think what differentiates us from most other banks is our focus in the tech ecosystem, our position in the community. We like to be a portal to connect founders with other founders, entrepreneurs, and working with venture capital companies as well. So feel free to reach out to me. I'm happy to talk to every single one of you, and it's nice to see you all here.
Fantastic. Thank you, Naveed. Peter, do you want to say a few words?
Sure. Yeah, thank you so much. Yeah, I'm Peter Mansfield. I'm with CMO.LA. We do marketing and also help startup companies with their fundraising. We're a small company. In fact, the entire company is here today. My colleague Leslie is here. My colleague Garrett is here. And then our lowly intern Lawrence is here as well. So yeah, we help companies all the way through from strategic to tactical level marketing. Just take them through C rounds, A rounds, and beyond. And we've had some nice exits, and very happy to be here. So thanks so much to Heidi as well for getting it all set up. It does a wonderful job every time.
And Michael, do you want to talk a little bit about us?
Sure. I'd love to. Thank you, David. Thank you, Christian. I appreciate it. And thanks, everyone, for coming. So my name is Mike Lilly. I run business development for Early Growth Financial Services. And we are the nation's leading provider of outsourced accounting and finance support for high-growth startup companies. So that really boils down to 4 key areas: corporate taxes, personal taxes, 409A valuations, and day-to-day accounting support and CFO support. And we also help our clients with fundraising as well too, and just very outward facing in the community and do our part to get back to it. So again, thanks everyone for coming, and hope you enjoy the show.
So what we'd love to do, Christian, is if you could give a little bit about your background and your investment thesis, and then we'd like the companies to actually introduce themselves and talk for 30 seconds or a minute about what they're doing.
Great.
Okay, fantastic.
All right. Well, thank you so much for hosting me here. It's always a joy to come to LA. I'm based in San Francisco, which is where Comcast Ventures is headquartered. And San Francisco is a great city, but it's substantially beachier and warmer down here. So it's nice to visit you all. So let me give you the high level on Comcast Ventures, and please don't be shy. If you have any specific questions, I'm happy to answer them. The key thing I always like to describe about Comcast Ventures is that the name can be misleading. So we are the corporate venture arm of Comcast, the big cable company, which some people may have a positive or less positive impression of. And I think what gets a little misled in our name is that we invest in everything, including Dollar Shave Club. So what does a razor blade business have to do with Comcast? Nothing. And that's the point of our venture group, right? It's to invest in all types of emerging businesses, because our goal, like any institutional fund, is return on investment. So that's the first hurdle, and we're just excited about exciting technology businesses building big companies. Now, you can go and get capital from a myriad of different sources, so why take our capital? That's where we think the Comcast part comes into play. So Comcast is a very large corporation that you're probably mostly familiar with for the cable distribution. So folks have a cable box in their home, and that's how they see television. But Comcast also owns a sports team, Philadelphia Flyers. They own a big venue management business. They own Fandango, which is the movie ticketing app, and Comcast is now also NBC, so all of those television properties, Universal Studios, both the film and the theme parks. So it's a very, very broad portfolio of businesses, and the reason I highlight that is when we invest in a company, the goal ultimately is that we can unlock some value for them through Comcast. And that's never promised, and that's never guaranteed. So we don't only invest in businesses where we see a clear line of sight to Comcast could be a customer, you could do a partnership on one of the TV shows to have your product displayed. But we do think about that as a unique way to add value. And similarly, we try to help the companies we invest in if they're working on something with Comcast where we think they're kind of wasting their time. In other words, having people at corporate lead them along, we try to nip that in the bud and make sure they're focused on really growing their business. So I think, what am I leaving out? The fund size. So every year we deploy $150 million. That's roughly 2/3 into new investments and 1/3 into existing investments. So we're a bit unique in that we have annual fund vintages. And then in terms of the check sizes we're writing, it's typically anywhere from $200,000 at the seed stage to $10 million at the later stage. So we do go early, we do go late. But the bulk of the capital we deploy is typically $48 million in Series A and Series B. And then just sector focus, it's easier to really describe what we don't invest in. So we do not invest in new drug discovery and biotech stuff, and we don't do renewable energy. I think those are both really exciting areas, but they're just not our areas of expertise. The areas we're much more focused on these days are consumer, financial services, where I spend a lot of time, enterprise software, and then augmented reality, virtual reality, Internet of Things, really anything that's not biotech or renewable energy. So I think that's pretty much everything, but happy to answer any other questions.
That's awesome. And everyone will have a chance. We'll leave at least 15 or 20 minutes at the end of this conversation for you all to ask Christian questions. But first, just so Christian gets a sense of who's in the room and the types of companies that you represent, let's go around the room quickly, and if you could just give a little blurb about what you're doing. You want to kick us off?
Sure, I'll do it.
I think we're going to go without the microphone for this.
Okay, great. I'm Keller Crawford. My company is Paisley. It's a customizable autopilot for personal finance. We're the only app in the world that I'm aware of that will be allowing one user to give a percentage of a check, for example, to another user. So one of the things that will be really useful for it will be paying back loans. So if I borrowed $1,000 from my dad, I can go out, whether I have a job or not, I can create a Paisley plan. And as I earn money, a percentage of that can go to my dad, and I can set a threshold and say, only pay my dad back that 10% if I'm good, if I'm out of the red. So, yeah.
That's great. Let's a little bit quicker, just so we can make sure that we get through everybody would be great. But you want to go ahead and introduce yourself?
Sure. Hi, my name is Justin. I'm the CEO of Play My Ad, personalized TV. We've raised $2.9 million in venture capital to date. The personalized TV is basically a TV platform similar to Comcast cable, except for businesses, where we use computer vision and face detection to detect the audience and optimize the program, and also deliver analytics back to the advertisers. And what's unique about our platform is that it actually enables any subscriber within our network to cross-advertise. So retail businesses can now cross-advertise in their local area and pick and choose which area they want to promote their own brands.
Hi, Ethan Taub. I'm CEO of OfferEdge, and we self-funded, so we grew 1,700% in our second year, and we've created all new personal finance experiences from the ground up, so working with the underbanked, building products that go all the way up. And we have two sides of the company. We have our consumer offers, and we have our business-to-business portal that allows experts to sign up to get to the consumers.
You did say you're leaving 15 to 20 minutes at the end for the companies?
For questions.
Oh, for questions, got it. So, founder of two companies, one of which I'm the CEO of, RideSwell. We launched just last Friday. It is a rewards-based carpool app. So effectively, we are gamifying the reduction of CO2 emissions by rewarding people who carpool doing what they love. The platform also raises micro donations for our climate change nonprofit partners. We have a sister 501c3 that was approved by the IRS in February, which is our pass-through vehicle per se for those fundraising part of the platform. The other company I founded that launched in November that my partner CEO of is called Shootly. It is a Uber for photography and dronography, as we call it. It has 4 categories: real estate, events, portraits, and sports.
Thank you very much.
Hi, I'm Elizabeth. I'm the founder of Webusel, and we're developing a patent-pending algorithm that's basically taking a user's past browsing history and delivering more relevant results to them. And we're looking at a target market of higher education and research community as well.
Great, fantastic.
I'm actually one of the sponsors. I'm Anna with TriNet.
Oh, fantastic.
Hi, my name is Alpa Patel. I'm founder CEO of Spaces. What we're doing is building a digital media platform that connects owners, operators, and developers of commercial real estate with professionals, architects, designers, general contractors, and manufacturers. So bringing that ecosystem together. We're essentially like house for commercial spaces.
Great, fantastic, thank you.
My name is Kevin. I'm co-founder and COO of NV Drones, and we create management software for commercial drones. So we basically help any company that's deploying drones to keep track of their pilots, equipment, as well as all the compliance and like flight equipment analytics.
Very, very cool. Lots of cool companies.
Cool. Hi, my name is Sumai Patel. I'm from CapEx, and we've created a web interface and API for corporations, crowdfunding portals, real estate investment trusts to manage their equity investment as well as their debt. So for startups, the most relevant is we're a capital management software.
That's great. I think next is
I'm a participant also. So my name is Tony Smith. I'm here with Drone Fleet and Aerospace Management, and then also Control Me Robotics, sister companies. On the drone fleet side, we do commercial operations for 3D mapping, inspection, and things like that. Sister company, Control Me Robotics, has developed a ground station that's a fully autonomous remote launch, deploy, survey, recharge system with proprietary sensors where the drones can be launched from your iPhone, flown anywhere remotely, do an industrial level survey, come back, land, recharge, send that information, we analyze it, and then create 3D maps, other things that go into virtual reality, crop analysis, industrial surveys. So we're raising money in both drone fleet and control.
Garrett Gilbertson, I work with Peter at CMO.LA.
I'm Kyle Cox, CEO and co-founder of Ballers World, which is a global basketball community. Community being 500 million people who play basketball daily around the world, and the 14,000 or so courts that we preloaded into that. We allow people, we allow players and fans and whatnot to find courts to play games. rank each other after the game, kind of like a Yelp for basketball, to kind of create this ranking system to determine your worthiness as a basketball player. We also allow content to be created, and we have some of the top content providers, basketball related, on the internet within our app as well. And for retail companies and whatnot, where we allow them to direct the consumer to basketball players, so they can reach their target demo before, during, and after they're doing the thing they're trying to sell. So.
Awesome. Fantastic.
Hi, my name is Edwin Choi. My company is Captech, and we allow financial advisors to personalize personas for every one of their clients. What's really amazing is that advisors today, they really only have 5, 10, 20 personas that they use with all of their clients, even if they have hundreds of clients. So our system lets advisors, in a very simple way, to personalize a unique persona for every one of their clients and implement it just as easy.
Great. Fantastic. Thank you.
Lawrence Lee, I'm just working with Gary.
Good deal.
My name is Tom Zariga, the CEO and founder of Magnetic 3D. We develop glasses-free 3D display technologies for the commercial industry. Our display is actually just around the corner if you get a chance later to see it. We focus on technology for retail, experiential marketing, and we're actually launching our own 3D digital signage network now in New York with a number of brands that will be sponsoring. So if you look forward to learning more, checking out the technology, I have the first 3D tablet here as well.
Awesome. Very fun.
Hi, my name is Claire. I'm here with WIMP. WYMP stands for What is Your Most Popular? It's designed to help you find food faster, so unlike Yelp, which lists a whole bunch of restaurants, WIMP is actually used by peer users that load up, like if you're looking for your best tacos, it'll tell you where to find tacos within a 3-mile radius. So it's just help you find food faster with the food.
Very cool.
Hey everyone, my name is Brian Conyer. I'm the founder of GiveLib, which is an online library for surgeons to share medical lectures and surgical videos. One of our key initiatives is to place VR and AR into the operating room to provide a real-life operating experience. And next week we're broadcasting live one of the first surgeries in using 360-degree video technology.
Awesome.
Hey everybody, thank you for having me. Naveed invited me. My name is Frankie. I'm founder of Market. Just joined the Amplified Accelerator program. My background was building out brand ambassador programs for Uber, and then I built it out for Lyft. So I built out sales teams of thousands of people to generate new customers for pretty much any company. Comcast would be an interesting one to do. And so I can basically get thousands of college students, moms who have blogs, social influencers, commission-based marketing to generate new customers. You only pay for new customers, so pretty cool little thing we're doing. Thanks.
It's fun.
My name's Ryan. I launched a dietary supplement company 3 years ago. I now sit on the board. I got into real estate. I'm also in a few startups around town. My partner's in a bunch of funds, so just kind of active in the tech ecosystem.
It's good to see you, buddy.
Sure, my name is Leon Katoch. I'm CEO of Terramonta. Terramonta is a commodities and price intelligence company. We analyze geopolitical drivers as they impact the fundamentals, meaning supply, demand, inventory distribution, and ultimately how they influence the prices of commodities like in crude oil. So if anybody is interested in crude oil and where the price is going, you probably need our software. So.
This is an exciting time probably for your software. There's a lot going on.
It's extremely exciting. In fact, we were tracking Brexit as an example and the impact on the commodity markets. Just to give you just a couple of data points. Rare earth metals are in almost every iPhone that you guys have, and of course, China controls 90% of the output. In fact, the situation is so dire that Honda just made an electric motor that uses fewer of rare earth metals. In fact, the supply chain dependencies are very, very critical. If you think about a company like PepsiCo, they buy $20 billion a year in commodities. So imagine if sugar doubles in price, what will be the margins on the major product lines? So a commodity, the volatility of commodity prices have been identified as one of the top 5 geostrategic risks by a recent McKinsey study.
That's awesome.
And it's going to get even worse. So anyway, so thank you.
Thank you.
So.
Hi,
Hotel CEO at Ernie. We built a personal assistant that automatically gets you money back on every purchase you make. We automated price protection, which is a benefit provided by the credit card issuers and the e-commerce stores. It means that you can purchase any item. If the price drops after the purchase, you can ask for the difference. We are doing that for you. You log in to Ernie with your email account, which gives us permission to extract your e-receipts. And then Ernie search for better price, claim the difference on your behalf. We are charging 25% and we are targeting $50 billion that are left on the table every year.
Hey, just before you jump in, guys, if you want to sit down, we've got a bunch of seats up here also. If you I got seats for you. So.
Hi, I'm Andreas Newman, founder and CEO of a company called UAV-IQ, which stands for Unmanned Aerial Vehicle Intelligence, so drones obviously a hot space. So we're operators focusing on agriculture. We operate in Chile and in the US, again 12 months a year, but our big focus is bridging the gap between the drone operators for agriculture, which is growing at around 42% per year, and the consumers on the ag side of remote sensing data, which is growing at about 18% per year. And we bridge those gaps by building some of the cloud processing, but we're also building enterprise software, which is really solving the problem of how, as an agricultural consumer, do I use this and make money. So we're really focusing on bridging that and making the imagery more actionable and making it an enterprise and something that they can incorporate into their daily business activities on the ag side.
Great, great.
I'm Marty, CEO and co-founder of Lockaware. We're building software to seamlessly dispatch our network of pre-verified locksmiths and physical security professionals. The goal being to help people avoid the 9 in 10 fake locksmiths on platforms like Google, Yelp, and Angie's List today. We are awesome, and we're trying to help people. We're trying to help people better understand physical security at their homes and businesses.
I should just point out, Christian, that they're all awesome.
Hey, I'm Corey Aslino. I'm the CEO and co-founder of Rally. We are a customer acquisition and rewards platform that uses IoT devices to actually get people in locations to download and engage with mobile products. And actually, Liberty Global and Virgin Media are two of our investors.
Awesome.
Duncan Swayze, co-founder of Record.
There's a couple of the guys that jumped up. Yeah.
I'm Ron, this is Saul, and our company is named Round. We are an investment advisor, app-based, and we are the first ones offering hedge fund level investing just for everyone. So the kicker is that we're the first active manager in the space, and our team has managed over $10 billion at one of the largest hedge funds.
Great, great, fantastic. And then,
I think I'm the last one, maybe?
I think there was one other gentleman.
Okay.
Yes, my name is Jose. I'm a CEO of chillhound.com. It's an event management software that allows people to crowdsource for their own personal events.
Great. Fantastic, thank you.
I'm Yushi Wang from China, and we are creating a platform to use social interaction, community, and transparent, structured bullet points to organize events and to revolutionize how people use it.
That's fantastic. This is a great group of people. So thank you all so much for spending your lunchtime with us and coming in. I really appreciate it. It is 12:20 right now. Peter and I will ask questions for about 15 minutes, and then we'll give over the floor to all of you. So if you all have questions for Christian, we'll leave 20, 25 minutes for that at the end. You want to go ahead and kick us off, Peter?
Sure, yeah, I'll pick up on the topic of conversation I've heard a lot of people mentioning, which is a Dollar Shave Club. I'm not sure if everyone's aware, but they were acquired last night by Unilever for $1 billion. So I'd be interested to sort of get your take, particularly because you've got an insider's view on that, as what you think the impact of that will be for a community like LA, which is still, to some extent, sort of trying to find its sort of place in the world, in the startup world.
Sure. Yeah, so purely coincidental that, so actually a bunch of my team is down here in LA yesterday when this all announced. And so we've been investors in Dollar Shave for about 4 years now. Awesome people over there, really excited for them. Definitely a big win for some of my colleagues who made the initial investment. My 2 cents on that question, this is probably, hopefully this isn't an overly recycled answer. Some of you may have heard of it, some of you may have not, but I think there's a lot of wisdom to it, which is LA hasn't had a lot of huge tech exits. In fact, I think this is
to date, the biggest one. And there are other still privately held companies that are really large that are built here. SpaceX, billions and billions of dollars. Snapchat, right? And when those exit, those will have a huge impact as well. And not to discount plenty of other large companies in other industries, but purely tech related, this is really one of the biggest liquidity events for the area. And I think the immediate impacts are really twofold. One is just very legitimizing for the LA startup ecosystem. In fact, we were joking with one of our colleagues last night who's based in New York that maybe he should move to LA because with this exit, there's now been, depends how you cut the data, but there's bigger dollar value of exits in LA than New York. So that's actually a pretty big deal. The secondary effect is you've now got a bunch of newly minted millionaires, and those people will become angel investors and supporters of the broader ecosystem. And that's something that people don't often think about, but in Silicon Valley you have everywhere. I mean, you have all these companies, going back to Sun Microsystems and earlier, from decades and decades of people who then go on to really be involved in the ecosystem, both as capital providers and advisors. So I think both just as a legitimizing factor and secondarily in terms of incremental capital and advice to the startup ecosystem, it's a really big deal.
That's fantastic. Christian, we've been hearing a lot in the news over the last several months about an upcoming downturn, or that we're in a downturn. We've been hearing a lot about a slowing down in funding. Can you talk about what you see for the industry, especially in early stage tech, for the next couple of years?
Sure. So my answer would be we're already seeing it and or have seen it. So I've been working in venture capital for 2 years. I started in the summer of 2014, which was really not quite at the very top of the hype cycle, but pretty close to it. And the deals we would see get funded and the valuations at which companies would be funded, and the questions we and other investors were focused on are dramatically different from what they are today. I think the amount of venture dollars available in the financing environment isn't bleak. It hasn't fallen off the cliff, but ones I can't say the names of, but companies in our portfolio that easily would have raised money with certain metrics 18 months ago, the same metrics won't allow you to fundraise today. And those metrics are primarily, really growth was king 2 years, 18 months ago. And now growth is still important, but you can't just be, lighting cash on fire to grow and have people fund that. So we increasingly see, frankly, for the investors, it's refreshing and nice because you have to remember investors have to report back to their LPs and earn a return on what they've been investing in. And when valuations got really heady, that really made it kind of a tough proposition. So the pendulum of who the financing environment is more in favor of, the entrepreneurs or the investors, kind of swings back and forth. I think 2 years ago it was really in favor of the entrepreneurs. I'd say it's still net more entrepreneurial friendly than not, but it's definitely not as loose money kind of policy as it was 2 years ago, 18 months ago.
Fantastic.
One of the notions that flies around town here quite a bit is that Southern California companies, particularly ones from Los Angeles, valuations are not as high as ones from Silicon Valley, San Francisco, and also to some extent New York. I'm not sure if that's a factor of sort of an insecurity complex or whether that's a reality of being in a smaller market for startups. And I'd be interested to sort of get your perspective on that.
I think it's absolutely true, Snapchat aside and some of the really large high-flying companies aside. But yeah, it's definitely something we talk about. Like, we would love to find more deals in LA for a variety of reasons, one of which being they're going to be more reasonably priced. I think actually the most important thing to talk about there, and that I can't impress upon the folks in this room enough, is that optimizing for valuation is really the wrong thing to do. And I haven't been an entrepreneur, so I totally respect the desire to keep as much ownership of your business as you can. But what happens for a lot of companies, particularly in Silicon Valley, that focus so much on can they raise at as high a valuation as possible and as much money as possible, you're just really narrowing the opportunity set for you in terms of your ability to exit down the road. It's funny, I meet with probably maybe 400 companies a year, and almost every company thinks they're going to be $1 billion company. And I wouldn't tell you to think about it any other way, right? You've got to
aim really big. But the fact of the matter is, you can build a great business and be incredibly financially successful for you and all your employees at numbers way below $1 billion. But what happens is, if you raise money at a super high valuation, you're limiting the ways in which you can go and then raise additional money, or that you could be acquired by someone. And we've seen this a lot actually in the last year as these valuations have come down. Companies that raised money at really, really heady valuations now find themselves in this awkward situation where they need more capital because they're not yet cash flow break even, but they're having to go back to the investor community hat in hand, and they're getting kind of down rounds put on them, which is always just bad optics and becomes really messy. So I just think that yes, valuations here are lower than in Silicon Valley, and I think in many ways that's a good thing.
I absolutely agree with that, by the way. We're seeing more down rounds with our client base in 2017 than we've seen in years. So it's huge times are in 2016. When you meet with a company, especially at the seed stage, and you're looking at being their first institutional investor, what are the things that you're really looking for, and what are the things that you're focusing on?
Sure, I think, so we don't do a ton of seed, but I have worked on a few. Maybe I'll just make a direct example, which is a deal we co-led about 2 months ago. A company called Bunker that provides a marketplace for contract-like insurance. So if you are Stubbs Alderton and you're going to hire an IT professional or an electrician to come in and work for 3 months, you might go through a large staffing agency, and you might be hiring a contractor who doesn't yet have insurance. And you need to find a place to get them insurance. And so Bunker basically works to provide a platform where you can go and buy that insurance digitally, and most of this is bought offline. Anyway, enough about them. But the reason we did that seed deal is we had an extremely sharp management team of the CEO and the CTO had both worked in the insurance industry for years. And so it really depends on the business, but we tend to have very specific theses about certain industries, and so insurance was one where, at least in such a technical part of the insurance stack, we really wanted leaders of the company who had experience in insurance. That's not to say I don't think you can't come in and disrupt an industry without having experience in that industry, but it's kind of case specific. So for a very technical space like insurance, we really liked that the team had kind of deep roots in that industry. So that's one thing. I think another is a really big market size. That's you've probably heard that before. And then more than anything else, a team you can work with, because when you're investing in the seed stage, a lot of it is you're going to be providing a lot of time and hopefully value add to these companies. And frankly, for all of us in this room, right, time is your most precious resource, and so you want to be sure you're making it bet on people you get along with and are going to be able to receive your advice.
That's awesome.
Yeah, we help a lot of companies put together pitch decks and just in general sort of prep them for going out and raising money from both angels and from VCs. In fact, we done some pretty successful webinars in conjunction with Early Growth called Beyond the Pitch Deck. It's all about the psychology of raising money. But one of the things that still fascinates me is the first 5 minutes of a session when you're walking in to pitch a VC in particular. Angels not so much, but VCs in particular. What are the sort of the dynamics of that, and what can a startup do to really impress you in those first 5 minutes?
Yeah, it's tough. It's such a, it's like dating this whole thing, and it really is, right? So and it's funny, the spectrum of how people do it differently. So, there's always, it's always, you kind of have to read a room and try to, the beginning of any pitch, right, is, hey, nice to meet you, where are you from, and kind of cordial, and then you'll see when you'll jump into the deck. Different investors like to see different things. I think most of the people at our firm and most people I know are very visual, so having that slide deck is incredibly helpful. And maybe, I guess just a couple direct, thoughts on what to do, what not to do. Don't have like a super, super long detailed deck that you're going to get lost in the details of. It should be a combination of a conversation, but also you can reference the slides. And maybe if you have a lot of other slides you want to show, you can have them in an appendix so that if people have detailed questions, you can refer to them. I think one of my biggest pet peeves, and I'll just be brutally honest with this, because it happens a fair amount, is you're sitting in a room, and by the way, as an investor, you're pitching the entrepreneur on why you're so great, and they're pitching you on their company, and you're both trying to impress the other, right? It's like dating. And one thing that people sometimes do that just really drives me, wild, is people will, I don't know if it's a sales technique perfected somewhere, but people will say your name a bunch to try to like really, and Christian this and Christian that. If I hear my name one more time, you're going to lose it because this is not helping. Thank you, this is hurting. So don't say the other person's name too much. Sometimes the point is you're not gonna convince someone to invest in your business just by delivering the greatest pitch ever, right? I mean, having a really good pitch is important, but you've also got to find the right fit in terms of a fund that is an investor in your space, but also that's just at a place where they're ready to be investors. One of the hardest things about being an investor is passing on deals. So if I look at 400 deals a year, I probably pass on 397 of them. I hate it. It's really, really painful. And the best thing for us to do as investors is probably to do it quickly, but it's always really painful because you're telling someone that their dream, their baby, you're not gonna hop in with them. But I think what's really important is just being okay with that sometimes people are gonna say no, that's fine, and not once again you want to sell, but don't oversell because that kind of gets to be a bit awkward.
We're at a very exciting stage in technology. There's a lot going on multiple different fronts. I know that Comcast is looking at a lot of different areas, but what gets really hot right now? What are you excited about?
So, let's see, a couple of things. One, I didn't think I would have this as number one, but one is virtual reality, augmented reality. I apologize to the person in the audience who's building a business in that space. I, frankly, know very little about it, but I have two colleagues who, that's where they spend most of their time, and we've been very active investors there. And I was initially very skeptical. This won't be news to anyone, but this whole Pokemon Go craze is, I have not played it. I intend not to play it because I have my own reasons, but
because you don't have children yet.
I'm not into games, which makes me really strange. But what's fascinating about Pokemon Go, right, is it's kind of the 0.1 version of what will eventually be the use cases for virtual reality and augmented reality, right? So on your phone, you can see that the little Pokemon is, sitting on someone's lap in this room or something. But obviously, what that proves out is that if people are that excited about doing that, then when they can have some glasses on or what have you, and actually not through their phone, but actually think they're seeing a Pokemon in the room, that they'd be excited about playing games and interacting in that way. So I just think it's very validating for kind of the future of VR and AR. So that's one thing. I guess the other two would be the insurance industry. There's been a ton of capital that's gone into fintech and a lot of great exits in the last 2 years. And then a lot of you have seen the online lending space has kind of come under a lot of fire recently. But just generally speaking, fintech's been a really exciting area for investment. And insurance, and I'm not unique in saying this, that if you're familiar with the firm CB Insights that provides kind of research on startup-backed companies, I get a different email from CB Insights every 2 hours about how hot insurance tech is. But I think insurance is really exciting. That's why we made one investment there. And then lastly, I'll just say marketplaces. I might have mentioned that the two areas I spend most of my time in are consumer internet businesses and then financial services. And then for consumer internet, for the last couple of years where we've been most active is marketplaces. So companies like Instacart and Hired. Hired's a platform for hiring technology workers. And just the elements of marketplaces are fascinating and make for really, Mike's back on, that's why, great businesses. And so it's not really revolutionary, but marketplace models, I think, just continue to be great businesses to invest in. So it's interesting because when I first started Venture 2 years ago, I was spending a ton of time looking for marketplace businesses, and it's always a measure of what's next. But even 2 years later, I remain incredibly excited about finding those companies. It's awesome.
Sure. I think Los Angeles probably has more than its fair share of incubators and accelerators. Of course, Pre-accelerator is probably the best of the bunch. But do you think when companies are pitching you, do you notice any difference between companies? And this is a generalized question, that have been through an incubator or an accelerator, and if so, any benefits there or disadvantages if you haven't been through one?
Generally speaking, I would say no, but it's more just, with the volume of deals you see, it's not always an exercise in kind of stepping back and thinking, that was a sharper presentation. I will say that sometimes I've been to a demo day that's like really highly produced, and Disney has an accelerator here. I've been a couple times, and I'm always I feel like the companies there must be prepping for like 10 hours a day in advance, just getting grilled, because it's like, not a word is missed, and it's really good, and that's impressive. So I think sometimes, I guess the results of these accelerators make for a slightly different pitch, but my take on that is really, I think accelerators, incubators can be really great, especially if you're new to the startup scene, or you're going to be exploring a category that you know less about. And whereas sometimes if you have really experienced entrepreneurs go through accelerators, that tends to make investors a bit skeptical, because they're kind of like, why would they need to do that if they've done this a few times? But I don't know if I really answered the question.
Yeah, it was kind of a generalized question. I was asking, I was thinking I'm on shaky ground here.
Yeah.
There was actually a really interesting article that came out on accelerators this morning. Do you remember where that was, Michael? It was the tech one. Okay, Gotti will send an email on it, but we should pull it up. Sorry, I think this is turned off for a second. Let's go ahead and open it up to all of you. So I think the best way is if you could raise your hand and we'll pick people, and then when you ask your question, if you could actually stand up and ask your question, and try and speak loudly, shout at us.
As far as your investment process, from introduction, first time you meet the company, whether it's through an email, whether it's a phone call, what's your typical due diligence process like? How many meetings? What's the quickest you guys made an investment? What's the longest? I know there's a broad range, but we'll just say you guys averages from a process perspective.
I think the quickest answer would probably be, and the answer is there's no average, but let's call it 5 or 6 weeks. And that can really vary in the sense that, there may be an entrepreneur or a company that we know we've been tracking for a while, so we've been talking to them for a year or years. But then, from actually when we start to get serious about it, okay, we've heard the updated pitch for the Series B, say it is, what happens from that stage? So that, that's the same thing to me really as we meet for the first time, hear the pitch, and then we make an investment. So what does that process look like? So typically 1 or 2 people from our firm meet a company, hear the pitch, say we're very excited about it, report back to some of our colleagues about it, and we may or may not decide to do an intro presentation. So maybe 1 week past the first meeting, we do an intro presentation, which for our fund and most funds is Monday morning meetings. It's when all investors have their meetings. We'll do a short slide deck that we'll walk through for about 30 minutes with our group, and people will tell us, I hate this, I love this, more often than not somewhere in the middle. Okay, this is what I think is interesting about it, this is what I want you to dig in on. So then we're going to take 2-ish weeks to do more diligence, talking back and forth with the entrepreneur, maybe doing some market sizing analysis, maybe speaking with some competitors, just kind of fleshing it out further. And if 2 weeks later we're still really excited, we may bring in the CEO or the management team to do a presentation for our team on a Monday. And then we'll also have prepared, which we will present separately, a detailed kind of update presentation on the business. And at that point, our group will give us an indication of relative check size and just how much interest there is. And then following that presentation, there might be one more final investment presentation a week later. So all that boils up to, and the process is never like identical for any given company, but on average, I'd say it's kind of a 5 or 6 week thing. I think one really key thing to mention there, I think most funds, you do all their work ahead of issuing a term sheet, but there are some where they'll issue a term sheet and then do more homework, whereas for us, if we're issuing a term sheet, that's totally binding. We've done all of our homework.
And would you say, Christian, that the length of time is actually extended over the last 12 months?
No, I wouldn't say that it's, what I would say is there were special situations and there always are special situations, but there were probably more special situations, from when I started in the summer of 2014 till the summer of 2015, where things moved a little bit faster. But generally speaking, I'd say it's kind of always the same. But once again, it's really situation dependent, and that cadence of, the first time we meet to make an investment being 5 weeks later could also be the same as we've kind of known about the company for a while, have the key kind of meeting, and then 5 weeks later we were doing it.
Great. Next question.
Again, my name is Frankie, and thanks for speaking. So you said you're interested in marketplaces, and you've been looking at those for a while, so let's use Instacart as an example. So a company that has a very high valuation. Question, or something I would like you to elaborate on, is unit economics, so actually acquiring those people who are delivering the groceries and actually acquiring the new customers. So how deeply are you diving into the unit economics on these companies, and what are like the main metrics you're looking on in terms of ad spend?
Yeah, sure. So it almost always, for these things, boils down to CAC to LTV, right? But everyone's customer acquisition cost, lifetime value, you can draw up a CAC to LTV, 6 ways to Sunday. So people present it and do it differently. So often a lot of the diligence we're doing is unbundling. Okay, you claim you have a $50 CAC and you claim the LTV is $150. When we actually dive into your assumptions and see if I agree with that. Is that an LTV of, is that all the revenue, or is that LTV of actual margin that the company's going to be taking in? Once again, it's not only CAC to LTV that matters, but I think that ends up being one of the most important metrics. But we spend a lot of time cutting that different ways. So there's a business we're looking at recently for whom that was really important, and they had a number of different acquisition channels, right? They had a partnership strategy where partners are referring them business, and then they're paying the partners. So, okay, how much are they paying for that business? Then there's paid, but paid can be any of 5 different channels within paid. So how much is the cost for each of the channels, and what is the conversion? Anyway, the point being getting really detailed about the numbers historically and projected behind the CAC to LTV analysis. Then for marketplaces, there are all sorts of marketplace dependent variables that matter. In the case of Instacart, that there's kind of 3 sides to the market, right? You have the shoppers, which are incredibly important, and you have to show the number of shoppers is growing, but also that the value to them, the money that they're taking home, makes sense, that they're not churning too much. How much does it cost to acquire a shopper? Because without the shoppers, you can't deliver the groceries. Then there's also how many grocery stores you have and how healthy is that evolving. And then there's the customer side of it. And then another example would be hired. It's really an analysis of, okay, how is the growth of number of companies on the platform versus how is the growth of number of candidates? So I think, to try to put it more succinctly, unit economics is really key, and it's really more than anything just diving in to get to a set of unit economics and specifically CAC to LTV that we really feel strongly about. But then also it is the analysis of both the supply and the demand side to feel that both are healthy.
That's great. That's fantastic. Other questions? Next question? Sure.
Following up on that question, is there a CAC to LTV kind of benchmark which you'd love to see?
Yeah, it's a tricky question in some ways, right? Because ticket size is going to matter, right? Like if your CAC to LTV is 3 times and that's $15 to $5, then that's 10 extra dollars that you're eventually bringing home to the business. Whereas if it's $1,500, $500, sure, it's still 3 times, but it's kind of a lot more money. The long-winded way of saying 3 times is kind of gold standard, but we've invested in businesses where it looks much more like 2 times. But it's rare that the revenue streams that a company's going to earn are so well defined, and more often than not, we're not placing a lot of emphasis in future revenue streams. So we're really looking at what do we believe the CAC to LTV is today. But then if we also know we think there are other areas where the business will expand and add value, that helps us get excited about. So no one would ever make an investment just on the CAC to LTV part. You could have CAC to LTV of LTV to CAC of 5 and a lot of other things that weren't attractive about the business that would prevent you from doing it. But 3 is generally speaking kind of, if there's a number, maybe that's the number.
Sure.
What are some of the biggest red flags that, when you're looking at a company, if you see it, then you will be a lot less likely to invest in that?
Yeah. So just issues with the management team. So you have to have, and this is such a kind of hyped about thing about how co-founders eventually it doesn't end up working out and ends up ruining a friendship. And the fact of the matter is it actually does end up being true because building a company is really hard and people have different views about the vision for a company. So red flags are anytime you don't think the management team is going to get along well and going to work well together. And then another part of that is their kind of commitment to the business. So sometimes we scratch our heads a little bit if we see management that seems to be paying themselves a ton of money. It doesn't happen that often. Or management that doesn't own a big chunk of the company, right? I mean, you want the management to really be incentivized. So if, because companies can come out of wonky kind of financing backgrounds where maybe some angel investor or corporate that they spun out of owns so much of the business that you don't feel like the management team has really enough. So that's really around management. I think other red flags, this is pretty basic, but just when things don't add up. So if you get told something and then you're doing customer reference checks and it doesn't add up to the pitch you were given. So I think definitely maybe a better way of saying that is if the pitch you've heard or the deck you've seen, the numbers kind of don't seem totally honest, that can be a red flag.
That's great. Hey, Christian, I just want to ask you another little question, Christian. So, when you said that you've got schemas for kind of evaluating categories of companies, and so I was just kind of wondering if you might tilt your hand to illuminate a little bit about what you're looking for in fintech. What are the absolutes?
Yeah. So it's tough, and we've been very active in fintech. So the companies we've done, we invested in College Avenue in January, which is student loan business. Now most of you think student loan, like, oh, refi, SoFi. It's not refi. It's you're going to college, you're sending your children to college, and you've exhausted federal aid or federal debt sources. It's basically an independent loan. So you're going to raise $50,000 from a bank to help you for college. This is a platform for doing that. College Avenue, Bunker, which is the insurance one I described a little bit. Bento, it's a debit card for SMBs with spending controls. And then there's a third we're working on that I can't speak about. But the similarity a lot of those businesses had, and I don't want to, this is something I touched upon earlier, I don't want to say that we wouldn't invest in a fintech business where the management team didn't have significant financial kind of industry background. Because the one we're looking at right now, the management team has much less of a resume in having worked at banks or insurance companies than the first three. But the first three all had management teams that really came from the space. So to give you an example, College Ave, student lending is an incredibly regulated space and one where you can get into a lot of trouble. And the management team there came from Sallie Mae, which is basically the incumbent. So there, I guess the answer is in really regulated areas of fintech, we've been very focused on having operators who've been in the industry. But this fintech deal we're working on right now, the management team is awesome as well. Less of a background in the industry, but it's a type of business where we don't think that's quite as key because there's not as much regulatory risk.
You've been waiting for a while.
Hi. So how should an entrepreneur go about connecting or introducing themselves to someone at the firm that has a particular interest in your type of startup?
Yeah, great question. And I think, look, a referral is always great. So anyway, I might get a cold email about a business and not want to take the pitch because just don't have the time. But if it comes from kind of a trusted source who really insists that I do it, you're going to do it, right? So having a relevant referral is really helpful. But even if you're just reaching out cold, if you reach out to someone that clearly invests in similar businesses or has blogged about or tweeted about, or their profile on their venture capital firm's website says these are the areas they cover, says that it's an area of interest for them, generally speaking, if you have a succinct email that describes that, people are probably interested in connecting. And I think most people are, up to speed on not sending like essays, but do not send an email that, has multiple paragraphs, because just no one's gonna get through it.
Let's go ahead and do 2 more questions.
So, businesses have been replacing their traditional TV services with our TV service. And I was wondering, would it be more efficient to approach Comcast corporate or Comcast Ventures about exploring synergies?
Yeah, it's a great question. Probably you and I can talk, and we can be helpful gatekeepers there. And my guess is, and actually as you were describing the business, my guess is, it's actually not an area of investment that I really focus on, but the short answer to the question, I think Comcast Ventures, because we can quickly tell you, someone within our group would want to talk to you, or let us ping someone at corporate and see if it makes sense for you to speak to them. And that goes back to my point earlier about us making sure your time isn't wasted, because there's this thing that can happen with both companies we're investors in and companies we're not, with big companies. And it's not the big company's fault, it's just what happens. So, you get introduced to someone at Comcast, say their name is Bob, and Bob's like, oh, this is so great, let me show this to Susie next week, we'll see what she thinks. Oh, great, Susie wants to come and meet with her. Susie says, oh, great, let's show this to Derek. You show it to Derek, and you just get nowhere, and you've just wasted 2 months of your life. So, and that's once again, there's something malicious about that just kind of happens, because most people within corporates aren't set up to kind of deal with inbound from early stage companies and work with them. So the answer to your question would be Comcast Ventures, in the sense that we could hopefully point you in the most efficient direction, whether it be with us or someone at corporate.
Perfect, thank you.
Yeah, since your area of concentration is largely limited to the 3 areas, would you have the time after this meeting to meet with anybody in the room that falls within those 3 areas?
Yes and no. There are, I think
that was a loaded question.
I think really legitimately a lot of the businesses all sounded really interesting, and a lot are definitely within my areas of interest. But if I were to say yes to that question, I think I'd be here a very, very long time. So there are definitely folks I'd love to follow up with, but and I will stay here a little bit after the event, but not too long, so I just don't think I have enough time.
I would recommend, if you do want to get in touch with Christian, you are all invited by one of the partners here. What I would do is I would go back to the partner that invited you and work through the partner, and probably the most effective way would be to get a paragraph in the executive summary to Christian, and then Christian can decide who he'd like to talk with.
They've all been provided to him.
Okay, fantastic. Okay,
yeah, so I have kind of a summary level. Okay. So I hope, there's always this, as a VC, you always don't want to kind of offend people by not meeting with them, but I think as this room is a good example, there might be, looks like 30 or so folks, that already starts to be a lot of people. So I'll definitely be working with the team here, and definitely following up with folks where I think there could be room to work together. And then also, I am happy, even if I don't think that we're potential investors for your business, if you have some question I didn't answer, I'm more than happy to try to answer it. My advice is worth what you pay for it, nothing, but happy to give it.
So, first of all, you all are fantastic. So I love the group of companies that we got today. So thank you so much for coming out and being here. And Christian, you've been phenomenal. So this is